Damn, Ingenious made the beat. Yo, welcome to another episode of the Coach Life Podcast Radio. I am, of course, your host, the casual one, Coach Steve. Join with me as always, the condor of chaos, Coach Luna. How we doing, brother?
Good, man. Good. Hoping people don't notice the frames I got on. You know what I'm saying? They nicknamed him Elton One. I don't understand why, but it is what it is.
That's a
Um,
good one. That's a good one.
right? It's pretty good, right? But I ain't gonna lie, kind of like Robert De Niro. But nonetheless, this right here, today is the day that you are going to pull out a notebook and you are going to write notes down. And I'm talking to the listeners out there. This is going to be one that you are going to learn a lot. Y'all heard us last time talking about finance this and finance that, a whole bunch of things that might have went over your head. Now we're going to bring somebody on that's more of a professional in this area to go ahead and clear up a lot of the questions that we may have and a lot of the things of where to go, what to do, just to give you an
Huge
idea of where
resource.
this pod is going today.
Huge resource right now. Again, somebody that's we can say a bona fide coach, right? Before we introduce our guest, CEO, founder of Coach Life Podcast, radio and brand about building your brand. Coach Wash, how we doing, bro?
You're doing great, man. I'm excited for this pod. Right now I'm just gonna be a student. I ain't saying nothing. I'm gonna sit at the front of the class, like Luna said, pen and a pad, and you just taking notes and picking up game.
Yes, sir. Yes, sir. I think we all have our notebooks ready today. I'm excited about this one. Again, we've already alluded to this. If you're watching this live, you obviously see that we have a very special guest on with us today. A current CFA, a financial advisor for UBS, Union Bank, Switzerland, 6 years of financial advising experience, Mr. Coach Casey Rosellini. How we doing, sir?
Man, I'm blessed. I can't complain. Life is good. Happy to be on here with you guys. Help some people out.
Absolutely. Well, again, before we jump into it, I want to say thank you, sir, for blessing this podcast because this is an area that myself, Coach Luna, Coach Wash may have a little bit more experience in because this is something that he's kind of taught a little bit. But for the vast majority of our fan base, a vast majority of just us here on the pod, this is the area that we all kind of struggle with when we talk about personal finances. So before we jump into it, Casey, can you tell our listeners out there a little bit about your previous background, where you come from, and why your experience is going to be super helpful today?
Of course. So, grew up in Houston, Texas. My dad is a financial advisor. He played football at University of Miami. So the two things I knew growing up were football and finance. Right, the U, exactly. Right,
Yes,
we're coming
sir.
back. We're coming back. But I knew football. I knew finance. So played football my whole life. Was fortunate enough to get to play at the next level, Texas A&M Kingsville. I got my undergrad in finance in 2 years, and then I got my master's the next year. So I was 21 with a master's in finance. I was like, what am I going to do with this? So I tried to go into basic finance, but what they don't tell you is entry level finance out of college is cold calls for the
Mm,
most part. Hey, you got to sell this insurance, sell, right? Bring people in. That's not, I got to get in front of people. I like to
right.
get there, talk to them, whatever. And I was 21 and just got done playing football. I was not ready to kind of step away, right? Like most of us aren't. So I went and I coached for 3 or 4 years. Started right in the middle of right beginning of COVID, so that was great. And then I kind of got to a point in my life with where my family was going and kind of my future plans. And I decided it was time to kind of step away from coaching as a career and went in, used my finance background, went into finance. It's a great job. Once you get to be an FA, like full-time FA, it's the best job in the world, man. You can work from anywhere. Um, you're just helping people out, making people's lives easier. But I still coach. I have my own quarterback training business on the side. I've been helping Luna out start his training business. He's about to launch. It's been fun for him. But man, I'm very happy, and that's what financial freedom. Money doesn't buy you happiness, but it buys you freedom. And
Man.
that's the big thing right there, man. You got the freedom to do whatever you want and follow your passion. So that's a little bit about me. I appreciate you guys having me on, man. I love helping out people because not enough people talk about finance. It's set a budget. It's like, how do I set a budget? So it's a lot of different things.
It's a lot of stuff that we miss. This is an area that we don't get educated enough on in school. At least I can say from my high school, and it was we talked about the most we talked about personal finance was open a checking account, open a savings account. That was probably like the basics, right? After that, it was, we never talked about 401ks. We never talked about spending habits. We never talked about creating a budget, living within or below our means, right? We really didn't have a whole lot of those conversations. So I'm super excited to dive very deep into some of these pieces. So let's kind of gear this conversation first and foremost to how do we start? Let's find a good starting ground. We're getting out of school, or we're in our 30s. We got a decent job. We're making some decent money right now. Where should we even be starting our financial journey?
Okay, so I don't know about you guys. A lot of times, people, especially out of college, 20s, 30s, you're making good money. You got enough money to do what you need to do. But every month, at the end of the month, you're like, man, I got barely any left over. I brought in 5,000 and I spent 5,000. It's like there's nothing extra, or there's very little extra, right? So that's usually because you don't really have, an outline of exactly where your money's coming from, where's it going on a weekly, monthly basis. So number one for me, I always say, you need to get an overview of your finances. Okay. They have a great like Rocket Money. I'm sure y'all have seen commercials they have where they'll go in and they will literally go in and show you, hey, you have all these subscriptions. This company charges you every month on the 5th. It shows you all your recurring expenses, right? Recurring expenses meaning expenses that happen, every month or every week, or streaming services, right? Stuff like that. So you need to create a personal balance sheet and income statement. So your balance sheet is your assets and your liabilities, right? Assets being what makes me money, what has value, right? Liabilities, things that, I owe, things that I'm paying, right? So like a car, okay, if that car is paid off, that's a good asset, right? If that car you're still making payments on, that's technically a liability because I know every month I got to make this car payment. Does that make sense? So like there's a little bit of give and take. There's some gray area on some of it, but at the end, your assets and your liabilities should be close to the same, right? Income statement. Where am I getting my money from? Okay, I get a paycheck, bi-monthly, twice a month. Do I get it weekly? How much is coming in? How much is deducted? What's, my gross versus my net? What that means is gross income before taxes, right? A lot of people, when they make decisions on their finances, they're using their gross number. Oh, I make $75,000 a year. No, you don't, right? That's what you may make before taxes, benefits, right? You're not bringing home $75,000. And that sounds funny to have to say that, but people don't know, so know your net income. How much are you bringing in after taxes? Okay. And that's not even your true net income because you have to go taxes, benefits, expenses, right? My monthly expenses. What do I have to pay for? So it gets into a lot of things, but you got to know where your money's coming in from and where it's going. If you don't, you're never going to be able to get on top of your finances, especially with like subscriptions, man. There's 3 or 4 subscriptions I guarantee you don't even remember you have. And they're charging you $5, $6 a month every month. Right. So you got to find a way to get there, figure out where that money's going and get it handled. It adds up very fast. Right. And kind of once you get that figured out, you say, okay, I know where my money is coming from. I know where it's going. Now I got to set some goals. Right. So, Luna, if I ask you what's a financial goal you have in the short term, what would you say?
Short term? Shoot, I want to get
within
my
6 months, a year, 6 months or a year, something close.
there's a certain number in my head I want my Roth to get to as far as crossing that next plateau.
Okay, cool. What about a long term?
Long term, I would love to go ahead and say I was the first millionaire in my family.
Okay, that's good. So your short term is I want to hit my Roth to a certain value, right? So when I make my budget, I got to keep that goal in mind, right? So I'm gonna have to have extra money in that budget so I can contribute to my Roth, or I got to stay disciplined with it. So your goals are going to determine the next step, which would be, how am I going to set my expectations for my spending? Okay. So if I know a lot of my goals are savings oriented, hey, I got to save, put my kid in college. Hey, I want to save for a nice vacation. There's nothing wrong with going on a nice vacation if you have the money for it, right? If you're going into debt to go on vacation, you probably need to rethink that.
Right.
But if that's a goal of yours, that's fine. Plan for it, right? Plan for it. So I set my goals. Okay, I want to hit a certain point in my Roth. I want to go on a vacation in a year. I want to do that. I want to get a new car in 6 months. Okay, there's your goals. Make them clear, right? If you have clear goals, it's going to make it so much easier to make those financial decisions, right? Don't be vague. Don't say, I want to be rich in 5 years. What does that mean? Right? I want to, I don't know. I want to buy a house in a year. Okay, what kind of house are you trying to buy? There's a big difference between buying a $300,000 house and $600,000 house in terms of the money you're going to need for down payment, closing costs, all that stuff, right? So with that, okay, this is the one that's going to hit home for a lot of people, and you're going to be like, well, actually, no. Live below your means. Okay, social media has been the biggest, and I'm guilty of it, and everybody's guilty of it. It's the biggest deterrent in people saving money and living below their means. Because you see people in your eyes that are in your, like, I guess, like friend group or level or whatever.
They're in the, right.
Yeah,
We're
in
in the
your
same tier,
hierarchy.
right?
Yeah, and they're going on nice dinners and they're going on vacations and all this stuff. Like, oh man, like that I should be doing that. No, every situation is unique, man. You cannot live to somebody else's standards. Fastest thing you'll understand, I'm sure you guys know too. If you try to keep up with the Joneses, if you try to look at other people and compare your life and live that life with theirs, it's never going to work, man. Every situation is completely different. Me and you could make the same amount of money, same expenses every month. But if my mom and dad are giving me money, which happens a lot more than you think, I can do whatever I want. We know people that went on like ridiculously expensive vacations this summer. I'm like, and I told my fiance, I was like, they don't have the funding for that. I was like, there's no way. Like, and it clicks. I'm like, oh, they're not paying for it, right? Or someone who bought a house in 2022 or 2023, right? A 7-8% mortgage rate, like 50,000 down. And I'm like, they probably make 130 combined. And then you realize, oh, they have help, right? So there's a lot of things you're not going to know looking at social media. And you're going to try to compare yourself and say, oh, we should be doing this. I should be here. I'm behind. No, don't do that. Live below your means. It may suck in the meantime, right? But later on, when you've been frugal and you've made good decisions, it's going to pay off tenfold. Man, it's like I know y'all heard in college, when you got to college, right? It was you can either have fun for 4 years and work your ass off for 40, or you can work for 4 years and have fun for 40. So if you just sacrifice, man, live below your means. Doesn't mean you don't have to do anything. Just be smart about it. Don't go out to eat all weekend, right? Don't treat yourself just to treat yourself. Okay. Everybody says it like with basic tasks. There's a meme. It's like, I finished a basic task at work. I got to treat myself with 5 minutes on my phone. Like we are so addicted to treating ourselves. Right. And that's me too. I do the same thing. That it's like, I got to learn, hey, I shouldn't be treating myself and do what I'm supposed to do.
Right.
And I think that's the biggest thing with living below your means. Quit watching other people's pockets. Just focus on you and your family and what you need to do. So when I set that budget, I'm gonna set it like I'm only making, if I make 5,000 a month, right? If our household makes 7,000 a month combined, right? I'm gonna set my budget like we're making 6, right? Or set it like we're making 5, 8. to really challenge myself. That way, if I do have a point where I can't really get it in there, I can't fit in that budget, you have some breathing room. Versus if you set that thing at 7,000 and you hit the point where you can't fit in the budget, where are you getting the money from? Right now, I'm dipping into savings. I'm having to withdraw from my IRA, which is going to get taxed. It's just, there's a lot of different things that can go wrong. So always adjust below your means. Give yourself room. You'll be amazed how much.
What would you say for that one individual that, and you probably know a guy like this. I know a couple people like this myself. I've been that guy before as well, who made a decent amount of money at one point and was like, oh, I see my paycheck, and then all of a sudden I'm immediately allergic to everything in my refrigerator right now. So I need to go and buy the expensive meal for myself, treating myself. How do you help that person start to learn how to scale that back for themselves? Now, again, this is still in the financial advising realm, because this is where we start, and we need to know how to scale back in a lot of these areas. How do you help those individuals scale back?
So it's kind of like what you're saying is kind of like when it's like, all right, I have a budget set for, like I said, $7,000 a month.
Mm-hmm.
Then I get a better paying job, or I get a bonus or whatever. It's like, oh, now I can spend this extra money. It's like, well, then if I set that budget at 7,000 and now I'm at 9, and then I adjust the budget to 9, I'm right back where I was. It's like, if I have extra money coming in and I can still cover everything with the same budget I had, right? Why would I change? So like with the food, it's like, all right, let's say I spend, it's going to sound funny. Let's say average number for 2 people, like average person, you and your wife, you're going to spend about $150, give or take, on groceries every week, right? 120, 150, just because groceries are really expensive right now.
Mm-hmm.
Okay. And let's say for the month you're spending, let's go high end. Let's say for the month you're spending $600 on groceries. Okay. So I'm spending $600 on groceries. We budget, go out to eat, once or twice a week, right? So let's just give a flat number. Let's give it, $850 a week. Or I'm sorry, $850 a month to go out to eat. Or we can make it around 1,000. Doesn't matter. When I get that jump in pay, right? Or I get a better paying job, right? If I now, let's get some extra groceries. Let's get the extra stuff. Let's go out to eat again. Let's do it 3 or 4 times a week. Why not? We got the money. Next thing you know, you're back to level, right? Your income and your expenses are back to exactly what they were. Nothing's changed. You're not hungrier because you're making more money, right? You're still as hungry as you were before. You just got to say, hey, man, just because I made more money doesn't mean now I got this really expensive taste. I think, and that kind of goes with what we just talked about, keeping up with the Joneses. I got to go out this fancy food. Man, my dad is a very successful financial advisor. He eats freaking oven meals half the time. He does not have expensive taste. And that's how you stay rich, man. You got to live like you were before. You don't got to live poor. Live at this, like you were happy when you were eating out twice a week. Why are you suddenly unhappy because now you have more money? That doesn't really make sense. So I think you find a lifestyle that works for you. And if it works for you at, your lowest income, it should work with you at your highest income.
I think that's probably one of the most important pieces on this piece, was just, again, that living below your means piece. That definitely hits home.
Casey, I want to pivot back on something that you mentioned earlier. You mentioned assets versus liabilities. And, I figured out something, and this was recent that I figured out, that your salary has nothing to do with your net worth versus your like that has nothing to do with net worth. So can we come back to that? And I want you to give advice to the person who may be on the other end, where they have more liabilities than assets. What can they do to, like you said, bring it back to balance, or even, tip the scale to where now that net worth is actually in the green? What advice would you give to that person?
All right. So correct me if I'm wrong. Most people like that are people like high student loan debt, in the hole for something, right?
Mm-hmm.
So
high credit card.
Number one, right. Pay off your highest interest bearing liabilities first. So if you got high credit card debt's usually like 20, 25%, right? Pay that off. Okay, now to pay that off, you're going to have to live below your means. It all comes back to that, man. If you were living above or at your means, you're not going to have money left over for that. You got to live below. Okay, take out the high paying interest first, because it's funny because you can pay off your low paying stuff just to say, oh, I checked it off the list, right? I got it, it's done. But while you're doing that, your credit card is getting charged 20-25% for every dime that you don't pay off. The small, low interest bearing, man, you could let those sit for a couple months. They're only going to accumulate a couple dollars, maybe $10, $15 every month, maybe, versus, 20% credit card. If you got $1,000 credit card debt, 1/5 of 1,000, you blink and you're like, oh, now I'm at 1,200. It piles up very fast, and usually you have higher quantities of credit card debt, right? So I think a lot of people look at numbers where it's like, oh, this debt is really small with the high, interest rate. This debt is big with the low interest rate. I'm just going to start paying off the big number with the low interest rate. Well, the problem is it's going to take you a while to pay off that big number. And while you're paying off that big number with that low interest rate, the small number with the high interest rate is shooting up. So you got to take out the high. If it has a high interest rate on a liability, you got to get that like done, gone, paid off. And then as you just kind of chip away at it, it's not going to happen overnight, right? Chip away at it, get those high bearing interest liabilities gone, and work your way down. You can get to the point where you're like, okay, at least I'm at the point where I'm no longer paying most of my checks or a good portion of my checks to these liabilities. Now I can focus on growing, right? So everybody wants to have a side business too, right? Everybody loves to have a side business that brings in money. Maybe decide, hey, the money I make from my side business this month is going to use to be paid off my debt, right? Maybe I don't get to indulge and go on, the boys' trip next month, right? Maybe I don't get to go to that wedding, in a few weeks in Hawaii, right? Maybe I have to sit back and chill and say, okay, I got to take care of this right now. Otherwise, in 2 years, 3 years, 4 years, I'm still going to be dealing with it, right? So you got to sacrifice. And it sounds goofy because that's what everybody says. Oh, you got to sacrifice. You got to, save money. You have to. There's no way around it. You're not going to magically get it forgiven, right? They teased at forgiving student loan debt. Somebody's got to get paid, man. That's the history of finance. Somebody's getting paid. So that was a great question, man. Just kind of chip away at it, right? Chip away at it. And then sometimes it sounds cliche. They're driving a really nice car, expensive car payments, right? And you're in debt. You see it everywhere. Living in a nice apartment, living in a nice house. Man, pay the debt off. If you got to downsize, get a used car, move to maybe a smaller apartment, smaller house, whatever you got to do, nix the debt, right? Get rid of the debt, because that will stay with you. That will follow you around like a dark cloud, man. You look like Eeyore, a dark cloud just above your head of debt. Because every time you get more money, guess who's taking it? Those people that you owe. Right? And if you can't pay it back, they're going to start taking assets. And you're really going to be in the hole. Right? So I think biggest thing is, I know it sucks to be in your 20s and 30s having to pay stuff off instead of going out and having fun and doing all this stuff. Man, it's so much more worth it down the line. So that's my advice: is start chipping away right now. Don't wait. Don't say, oh, I'll start next. No, do it now. You're gonna be very thankful you did.
So before we transition, I want to kind of make a quick comparison really quick, because again, for any of our listeners out there that have been paying attention, we've been talking about how to transition, how to hit that reset button essentially for yourself. And we talked about mental wellness, we talked about physical wellness, we talked about the spiritual wellness, and now we're talking about the financial wellness. There's a couple key things, Casey, that you brought up. One, being organized. Kind of having a real understanding of what's coming in versus what's going out. With that, being honest. I don't think a lot of us are very honest with ourselves. We want to say that we're making X number of dollars. And I think you hit the nail on the head when you said, we're talking about our gross, and that's not really what's coming home, right? We need to be talking about our net. I had a teacher back in college that made the comparison. You need to think about it almost like you're a fisherman on a boat, right? You have the opportunity to catch everything that's in the water right now, but your net only caught X number of fish. So I think if you kind of have that mindset, it kind of gets you to understand, like, yeah, you have the opportunity for this, but this is what you're going to end up with. Let's make a quick transition to someone on the a little bit on the other side. This person is kind of have a little bit more of a handle on their debt to income ratio. They kind of have an understanding of, staying on top of their debt, being organized. They're honest with themselves. They have a financial goal. Very much how Luna it kind of have some of these things kind of already mapped out. For investing, I got the extra money now. I have an idea of what I would like to do, but I don't know where to go with this dollar. Where should I be moving this money? Or not necessarily specifically where it needs to go,
Right.
but where should I be moving my money to make sure that I'm actually making smart investments?
Okay, that's a great question. So you're at the point where you're like, all right, I have some extra money, I can invest. Glad you said that. You should not be investing if you do not have enough money every month to fill your budget. If you are barely getting by, don't take $500 and invest every month. You need every dime you can to pay debt, pay your necessary mandatory expenses every month. You got to eat, right? You got to pay your rent, got to pay your mortgage, whatever, right? Your monthly mandatory expenses have to be paid. Then, if you have money left over, now I can invest. I can do different things with it. Number one thing I'll do before I even invest $1 is I'm going to build a good sized emergency fund. Okay. What that means is, now this is not an emergency fund. Oh, let's go out to eat. Let me grab $100 from the emergency fund. That's not what this is. This is something you contribute to every week, every month, and you leave it there because this has happened to everybody. Okay. Cars and dogs are the number one and number two culprit of this. I got my budget. I'm staying clean with my budget. I'm saving $300 every month on top of my budget, right? Or whatever it is. And then my dog gets sick. And then my car breaks down. Whatever it is, right? And now that budget is just screwed. Right now I'm over. Okay, I'm having to dip into my savings that I shouldn't be touching to pay for stuff. Or I'm having to go into debt to pay for stuff. Both not great options. So you need to start contributing to an emergency fund. Okay, so essentially you're setting it aside for some unexpected expenses. It's like a safety net, like you said with the net. It's a safety net, right? So that if something were to happen, I don't have to dip into my savings. I don't have to dip into another, like a vacation fund or something that I'm saving up for. I don't have to. I can leave it, and this emergency fund will take care of it. So it's a good idea. Generally, I put down a good idea to have enough in an emergency fund to cover at least 3 to 6 months worth of living expenses. Here's why. If you get laid off, say COVID happens all over again, right? Or some natural disaster. You get laid off, your partner gets laid off. Okay. Or just if you're by yourself, just you. It's going to take longer than a month to get a job. That's just how it is, right? That's today's job market. A job gets posted, there's hundreds of people applying to it. Okay. Especially if you want a good paying job. A lot of people want a good paying job. 3 to 6 months of expenses. Okay. Doesn't mean 3 to 6 months of going out to eat, doing all that fancy stuff. 3 to 6 months of living expenses, rent, food, water, utilities, things like that, gas. Okay. That way you don't have to touch. And I pray you never have to use it for income, but to be able to say, oh, my dog had to get a surgery, right? $600 or $1,000, whatever. I have it, rather than having to go backwards to go forward. It's like 3 steps forward, 10 steps back, And then as far as investing, okay, be honest with yourself. Like you said, what's my time horizon? Okay. So my time horizon is how long am I going to be investing? How long am I looking at this investment? If you're investing for retirement, say I'm 35 years old, then I got 30 to 40 years time horizon, right? But in reality, your time horizon, you're not going to stop investing when you're retired, right?
Right.
So it's really till your time to go, right? Till God calls you home. That's your time horizon. If there's a particular investment that, you only want to be investing for about 5 years, that's your time horizon. Okay. So the general rule is Your time horizon and your risk profile, okay, go together. So your risk profile, like how risk averse am I? If I'm risk averse, I don't like taking risk. I'm not going to get into a speculative or a risky investment, right? If I'm a bigger risk taker, then yeah, maybe I'll take a chance on a startup company, or maybe I'll take a chance on an investment or whatever, right? A more volatile investment, which we'll talk about in a second. But you got to know. So the easiest way to explain it, if I'm older, if I'm 70 years old, I'm closer to death than I am to birth, right? I'm older, right? I got maybe, 10, 15 years most of the time.
Mm-hmm.
I don't want to go and make a risky investment, right? And risk, losing that income that I have for the last 10, 15 years of my life. I'm going to play it safe. So usually the shorter the time horizon, the lower the risk, right? The longer the time horizon, like us, we're going to be investing for the next 50, 40, 50 years for the most part, maybe 60, hopefully. But we have more time, right? So if we're truly abiding by what we say and we're using extra money we have, right? We're willing to take a bigger risk to maybe, achieve a little bit of a greater return. I'm not saying trade a bunch of pink sheet stocks, meaning penny stocks, cheap stocks like Wolf of Wall Street. Don't do that. I'm saying go and maybe get that startup company that's kind of growing pretty fast. Just put a little bit in, right? Don't mortgage your future on it. But you can take risks, right? Because you got the time to recover.
Right.
Okay. So that's your big thing. Okay. What's my time horizon? How much time am I going to be investing? What is my risk profile? Be honest with yourself. Don't say you're a risk taker if you hate taking risks, because that's not going to help you. Right. You're going to be so hesitant with that stock. And the minute it dips, you're going to sell it. And you're not going to realize any problem. Okay. I mean, Luna knows we'd sit in the coach's office and talk stocks, and we'd have guys in there. The minute it went below its year high or year low, they'd be like, "Oh, sell, sell, sell," and then a week later it was above. So if you're risk averse, be honest with yourself. Don't get into speculative options, right?
Mm-hmm.
Stay with the comfortable, the safe investment. So as far as that goes, that's what I would go with. And now, this is what I'm going to say, because this is my experience. This is the way I've seen my whole life. I'm going to always advise we do something called prudent investing. Okay, so what prudent investing usually means is we're going to be very smart and careful. Okay, this is your livelihood. Okay, so in fact, if you go to the common terms of investing, I'll probably run through these first, so that when I start explaining prudent investing, nobody's like, "What is he talking about?"
Right. I'll pull it up now.
Okay. So investing 101. I'm going to keep it in layman's terms because it doesn't get taught enough like it should. So I'm gonna explain it exactly how I would want to explain if it was my first time hearing. So common terms. Number one, if you ever hear somebody say security, right? Security. What that means is it's like a stock or a bond. It's a financial product you can buy and sell. Okay, a stock meaning ownership in a company, right? Everybody's heard of a stock. Okay, a bond is a loan. So a bond would be like the U.S. government issues treasury bonds. So it's a long-term, 10 years plus, a bond that says, hey, if you give us $1,000 right now, we'll pay it back to you in 10 years, 20 years, 30 years with interest, right? So that's the safest investment you can make, is a U.S. government treasury bond, because it's backed by the full faith and credit of the U.S. government. Okay, corporations issue bond. It's basically an IOU plus interest. Portfolio. Everybody talks about portfolios, right? Portfolio is a collection of all your investments. Okay, you may have stocks, bonds, real estate, and there's ways to invest in real estate without buying a house, guys. There's something called a REIT, real estate investment trust, which is like a collection of mortgages and real estate, right? I won't get too deep into that, but the goal is a portfolio is you got to make money over time. Okay, it doesn't have to be a 15% return. Just make money, because if you have a sizable portfolio, a 5% return is significant, right?
Mm-hmm.
Diversify. So tying into the portfolio, diversify. It's exactly what it sounds like. Spreading your investments across different types of assets. Okay, so if I have all tech stocks in my portfolio, and the tech stocks take a dump, meaning they just drop through the freaking floor, my portfolio is down across the board, right? I took a huge loss. I gotta, they talk about putting all your eggs in one basket. Never put all your eggs in one basket. Diversify. Like Luna was telling me before about his Roth IRA. He has it spread, small cap stocks, large cap stocks, different sectors. So there's technology, medicine, pharmaceuticals. It's funny now they've got, what's it called? They got literally like sports betting. Like Barstool had they have everything, man. If it's a public traded company, you can invest in usually. So spread it out, right? Have a good mix. So that way, if one sector drops, the other one either doesn't drop or maybe it goes up, right? So you're balanced, okay? Kind of tying in with diversify, there's volatility. Okay, I'm kind of bouncing back and forth. The volatility is how much a stock price goes up or down. Okay, if one day it's up $5 and the next day it's down 7, right? Or it's taking these huge jumps. Okay, that's a very volatile stock. That's a risky stock, right? Because you don't know if you really need that money or if you're really counting on this portfolio to grow and you blink and now it's down 10%, right? Not everybody can handle that. Some people like to really know what their investments sit at, right? Like, for example, Apple, Disney, these blue chip stocks, they may take a hit. Usually they rebound somewhat soon, right? And they're not going to take a giant drop, right? You're not going to go from, $300 a share to $70 a share, right? Unless it's some crazy event that you have no control over.
They find a way to level out some kind of way.
Right. Exactly. Right. I mean, people lose money otherwise.
Right.
All right. So if we have a high volatility, a lot of price changes. Low volatility, not a lot of price change. Right. So it's less risky. You may not make as much of a return, short term, which shouldn't really matter, but you're gonna be a lot safer. Right. Dividends. Okay, this is a big one, guys. Dividends. It's sounds funny. It's pretty much free money. It's a reward you get for holding the stock. So the company, if they make enough money that they have some left over, they can say, hey, we're going to declare a dividend. So everyone who owns our stock, a shareholder, right, or stockholder, is going to get paid a percentage of our profit, right? So the more stock you own, the larger of a shareholder you are, the more you get in dividends, right? So they have dividends for stocks, okay? For bonds, they're called coupon payments, interest payments, same thing, right? So except there's no profits with bonds. It's just a monthly, quarterly, yearly, depending on what the agreement is. That's how often they pay you. So it's like you're getting paid. There's people that are retired that don't even have to worry because they have such large holdings in a lot of these dividends paying stocks. They just get paid, $1,000 a week from one stock, or they get paid, $4,000 a month from this because they have so much. It's just extra, right? And then last one, bull and bear. Everybody's heard about this, right? So a bull market, okay, is when market's doing well, prices of stocks are rising, people are making money on their investments, right? It's optimism. Okay, and they say, I kind of looked and said a bull charging ahead of strength and optimism. Another way to remember it is when a bull attacks you with its horns, it starts down and goes up.
What's up?
Right? It bucks up. So it's going up. Okay, a bear is the opposite. That's the market not doing well. They say like hibernating, right? That's how they teach it. But they also, when a bear attacks you, it comes down, right? So that's an easy way to remember it. So if someone says something is bullish, that means they think it's going to go up. If something is bearish, they might go down.
I had a funny way of remembering that, Coach. We from Chicago, me and Coach Steve. So the Bulls were up in the 90s.
Yep.
And the Bears been
the Bears were down.
That's an interesting.
That's a really good one. It's a really good one. No, it's whatever it takes to remember. It's helpful because sometimes if you're researching a company and you're reading up on these reports and someone says bullish or whatever, you want to know what it means, right? So just to be able to even have a conversation with people and understand kind of what they're saying is big. But just that's the background with investing. Those are some common terms you'll hear often. As far as prudent investing goes specifically, most people know prudent is being smart, right? Being smart, being careful. Okay. If it's your money that you're investing for the rest of your life, right? A lot of people only invest for their retirement account, which is fine, right? They don't have, just accounts just to invest in stocks just for fun, or to make some additional income. Sometimes it's just for retirement, which is fine. I'll be honest with you. I know you guys see on social media, it's like, oh, this guy made $10,000 day trading. Okay.
Mm-hmm.
Day trading, meaning buying and selling stock in the same day, right? Usually multiple times in the same day. Number one, on most commercial apps, retail apps, right? So like Robinhood, Webull, you have to have a certain amount invested to even do that. Like you have a limit. Like on Robinhood, you can do it like 5 times.
$25,000.
Yeah. So on Robinhood, you can do it like 5 times in a month before you get
Three times. It's 3 times in 5 trading days. Trust me, I know.
You can tell I don't day trade. So, but
Luna's got his hand slapped a couple times.
Yeah,
right.
Me too.
So they get you with that, and then guys, to make any money day trade, because all day trading is they're trying to track it, and then as soon as it takes a jump, they sell it, and then when it goes down, they buy it, and then it goes up, they sell. Like, do you know how much money you have to have invested to make a significant amount? So like people are literally going, as soon as it turns up like 2%, they're selling. Like the smallest turn. You would have to have a ridiculous amount of money invested in that stock to then go up like 1% and make any money.
To see the amount of money that's going to come, the return that's going to come off of that, right?
The risk is you invest all, oh, it's about to turn up, and then it goes, and you don't get that back.
Then you don't set a stop loss, and now it's.
Don't get me started.
I don't know.
But
you might hit a hot button with Casey.
But no, it's just anytime there's more risk with an investment, man, it's just it better be money you're willing to lose. And then that way it's like, set your expectations low. It's like, oh, if I lose it, whatever. It's like I said, sports betting. It's like, oh, if I lose it, it is what it is. But if I make money, you're pleasantly surprised, right? So it's just be careful with day trading. If you're doing it just with extra money, just kind of messing around with it, yeah, sure, whatever. But I would highly recommend just be smart, man. Like it may not make you rich tomorrow. It may not make you rich in a year, 5 years, 10 years, whatever. But when you get to be 60, 65, 70, and you blink, it's like, oh, I don't have any money in my retirement. I don't have any money put away, right? You see Walmart greeters working until they're like 80, right? You don't want to be working at 80. You want to be sitting on a beach somewhere, having a drink, just relaxing while the money works for you, right? So you got to sacrifice. It all comes back to sacrifice, man. It's like short-term sacrifice for long-term benefit. So yeah, maybe I'm buying the stock that doesn't make huge jumps, but over time, it's working up. So I told you guys earlier before we were recording, when you look at the economy in the United States over the last 80 years, all right, I will say 100 years since the Great Depression, there's the business cycle, right? So it's expansion, peak, recession, trough, expansion, peak, recession, trough, whatever. So you get dips, right? It's like a roller coaster, but over time, it goes up. So in a short little picture of the business cycle, it's here. But as you expand over 100 years, it works its way up. So while your investments hey, this year I only made 2% on that investment, right? Over the course of 2 decades, you probably up 10, 11, 12%. Right. Depending on what it is. So you just got to be patient, man. If you're investing for retirement, why are you trying to get rich now anyway? Right. So if you're investing for later in your life, you live on your salary just fine. You're making money. Everything's good. Dude, look at the companies that have performed well. Look at companies that are forecasted to perform well. Right. Do your own research. If you don't want to hire a financial advisor, do your own research. What's big right now? What's projected to be big in the future? Right? Read things. Okay. I know nobody likes to look at it's not the most exciting stuff to look at, but if you're serious about investing, yeah. But I mean, think about sports betting, right? If you're going to make a $50 bet on somebody's over or under, you're going to look up their stats and say, okay, what they do last week, what they do last time they played this team. It's the exact same thing. So I know personally, I bet on Patrick Mahomes every game for the rest of his career. That's like betting on a blue chip stock. It's going to be what it's going to be, right? It's not going to shock me, but it's going to perform.
I just got
right?
back from California. You're really hurting some people in the Bay
Well,
Area right now.
I mean, like it's what it is. Versus like I go in and I'm like, man, I'm gonna make this bet on. I'm a Texans fan, but I'm gonna make this bet on Deshaun Watson. And he throws 4 picks. You
Right.
know, so it's like it's high risk. You know, high risk, high reward. It's like no, I'm gonna stick with what is safe and I know is gonna do me well. So that's generally the idea. You know, some bullet points, careful and wise investment decisions. If you want to take a chance on investment, that's okay. Make sure that's extra money you have, right? Don't take your portfolio that you've invested and sell your blue chips to buy the speculative investment, right? It's speculative for a reason. Okay. You're going to speculate on whether you should do it or not. Okay. So don't take that chance with the risk of losing everything you built or a large portion of what you built. Base it on research analysis and your financial goals and risk tolerance. Guys, if you're risk averse, don't invest in something that's risky. Right? Don't do that. Doesn't make any sense. That's not your profile, right? And that's not who you are. You're not going to be comfortable. Okay. A risky stock requires patience. Okay. You got to know, hey, it may take a dip on that first day, but I'm playing the long game.
Casey, can you say that again for the people in the back? I don't know if they really heard that. A risky stock is a what? What again?
Stock or risky investment requires patience, man. If you are not a patient, if you are going to panic the minute it dips, you do not need to be investing in
At all.
Okay? No, you don't. So it was funny during COVID. I was in Hawaii with my parents, where my parents live, right? Being an FA treats you nice sometimes. But so COVID hits, everything shuts down. Man, I'm in Hawaii. My dad, so Hawaii is 5 hours, 4 hours behind in the spring. I guess it just turned 5 hours, whatever.
Yep.
Market opens at 9, right? So he is literally on the phone at 3, 4 a.m. with clients. They're panicked. People are like, I got to sell everything. My retirement account's in the ground, like whatever. And I had to watch him just like calm everybody down and say, hey, the market will always find its way back. Like it's going to come back. It's going to come back. This is the best time for you to buy that it's ever been. Like of all time. Like every stock hit like a low, like since its inception. Right. So if you spent that time buying, you're a happy person right now. Right. So people always talked about crypto and like, oh, if I would have bought Bitcoin, COVID, if you would have bought Apple, Amazon, Disney, Netflix, all these like really like big investments, you'd be up a lot right now. Right. But if you're someone that's going to panic the minute it drops, you probably shouldn't be investing a lot of money anyway.
Right.
Right. Playing the stock market is a lot like gambling. Right. Unless you're a U.S. senator, and then you pretty much you get
You better put on my tinfoil hat, man.
We don't want to get canceled now. We don't want to get
I
canceled.
mean, it's not even a tinfoil hat. No one has 90% returns against the market. But anyway, diversify your investments. We talked about that. Don't put all your eggs in one basket, right? Don't put all your eggs in one basket. Spread them out. Okay. It may not be a huge return short term, but it's going to pay off in the long term because you won't have any huge losses, right? Stay informed on market trends, economic conditions. I get a text from Luna every day about something he saw on Twitter. It was going on with the market, like a bank closing or something happening with the stock. And I'm like, chill out. Chill out. Usually we know about these things. We get market reports like weeks ahead of time about what's happening. So we usually know about it weeks, months ahead of time, but we can't share that because it's confidential. And I just gotta be like, calm down, calm down. And focus on long-term growth and financial security, man. If you're investing for retirement, if you're investing for later in life, don't prioritize the next 10 years. Be smart. Hey, Disney is never, I'm sorry, it's never going under. Like, and this is not investment advice. If you ever see Disney World, Disney Channel, Disneyland, and that doesn't exist anymore, we're probably all dead. Like they own
the nuke is dropped.
They own everything. So like that's when I talk blue chip, like we think of blue chip recruit, 5-star, right? High 4-star, 5-star, big time. You know what you're getting. That's a blue chip stock. So I'm not saying you got to just invest in stuff like that, but you should be backing the things that you know are going to be successful and consistent, right? That should be the bulk of it. And then avoid speculative investments and unnecessary risk for short-term gains. It doesn't mean don't do it. It just means don't mortgage your future and your portfolio on something that may or may not hit, right? That's why you save money for some speculative investments. People that have a lot of money, they have a special like folder or special portfolio for their speculative investments. And if it tanks, okay, whatever. That's just extra money, right? Don't tie those speculative investments in with your livelihood, right? So I mean, if you wanted to have like take a chance, sure, just make sure you budget for that. So that's my biggest thing. Is just be smart, man. This is your future. This is your future not only for you but what you leave for your family. You know,
I
I would
got a
also,
question.
yeah,
I got a question. So, all right, boom. I feel like if I'm listening to this so far, I've got a lot of information and everything, right? How do I and what do I do? I don't know if you can fully answer this. Like, what do I do? How do I go ahead and go about by opening up whether it's a Roth IRA or 401k? Should I be trusting to do something like this through an app like Robinhood or, these super simple apps? Or should I be thinking about a retirement fund into a trustworthy bank? What route should I be taking when I go ahead and think about opening up these accounts?
definitely the latter. So it's funny. I was talking to my dad about it the other day, and investment banks, guys, like big banks, you get so much, even a basic savings account. Like we have something called core savings at UBS, 4.6%. 4.6% on a savings account. Like you're not getting that Chase, you're not getting that Wells Fargo, you're not getting that Bank of America. So like you look at it and first of all, find professionals. Okay. Find a budget. If you're making good money and you got extra money, find it to hire somebody who does it for a living, right? Especially if you got a lot of stuff going on in your life. Finance should never be something that takes a back seat. It's not oh man, I'm busy this week, can't really look at my finances. That's not something you can do, right? So if you've got a lot on your plate, and you can afford it, maybe hire a financial advisor, right? Okay. So not every financial advisor deals with the same money. Some financial advisors are higher net worth in terms of who they deal with versus some advisors like at a local, like Charles Schwab, you can find a personal advisor. H&R Block has accountants and advisors, stuff like that. But find somebody who can help you with it, like a professional. Yeah. So yeah, you're gonna have to pay them like a percentage or a fee or whatever, but they should be making you money on top of that. Right. And then the stress of you having to deal with that all the time is now relieved too. Right. And you can call them anytime. Hey, I just have a question about this, or I saw this. What do you think about this? And they're there to help you. Right. But as far as Luna said, don't put your retirement money in Robinhood. Right. And you shouldn't go to a bank account that's not going to get you a lot. If you're putting the stuff just for savings, right, don't put it in an account that's not going to generate much interest. Otherwise, like when inflation outpaces the interest on your savings, you're losing money. That's why when people say when you put your money under your mattress, you're losing money. So
it's not working for you.
No, it's not. And it's got to be making something. Put it in a savings, put it in something safe, right? So there's money market fund. So a money market fund is something less than a year and until maturity. Maturity meaning when it pays out. So they have like negotiable CDs, certificates of deposit that banks offer. I'm not going to get too in depth about this, but there's a lot of things. When you look up money market securities, there are things that are short term. A lot of times they have inflation, guards against them to try to keep your money up to pace. Now, the thing is, you won't have that money for a year, right, or about a year, but it's money you shouldn't be touching anyway.
Right.
Don't put money you need on a monthly basis in a money market security. Right. So
should be the money you're paying yourself, right?
Right. So the money, like a bond, you're not touching that thing for at least 10 years. Don't put money you need in that. So the shorter the maturity, the shorter it takes to cash out means the higher the liquidity. So a money market is high liquidity, meaning how fast can I turn that security into cash? So how fast can I make it liquid currency? So a money market is a year, and usually it's pretty easy to turn into liquid cash. A bond or a long-term investment is not liquid, right? Because I got to wait. There's a waiting period. And a lot of times, if I sell it, I may not get what I paid for it, right? So you got to be willing. If you're going to put money in a bond, you're not touching that money. Don't touch that money. Right? Same with your retirement account. Don't go in your retirement account. What you say, Luna?
Question. Yeah, I got a question. So I'm in my account and I see this M word, okay, and it says margin. And it's offering that if I want to go ahead and turn this on, I can basically use this as money to make money. Tell me why I should probably never, ever, 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 ever play with margin.
Okay. So I come up to Luna and I say, hey, I'm about to put this 10-leg parlay down. It's going to cost $1,000. We're going to make $1,500,000, but I need like 500 from you. That's margin is I'm using borrowed money to invest. So there's when you invest in margin. So let's say I want to buy $10,000 worth of securities, right? Regulation T is a measure where they say, okay, due to Reg T, you have to deposit at least 50% of whatever you're going to buy. Okay, well, what does that mean? Now that other 50%, if you deposit the minimum 50%, that other 50% is borrowed money. So if that stock tanks or that investment tanks, they're going to get their money back. And guess what? That
With
500 or that 5,000 that you put in is now worthless if it truly tanks.
Mhm.
So they're like, hey, I still need my 5,000 back. How are you going to pay for it? So now you're either selling securities you own in other portfolios to pay it off, right? Which you don't want to do. Okay. It gets really ugly. Like it does. And I don't invest what you don't have, right? Don't invest what you don't have. It's that simple. It's just, I talk about, I'm using sports gambling because that's what's hot right now.
Mm-hmm.
Don't hit deposit on your sports gambling app. Once you put your money in for the month, don't add more money. Same with your investing. You have a budget to invest in. Now, if you have some extra money from your investments and you want to, take a chance on something, whatever you invest, just buy it with don't go on margin to buy it. You have the
Keyword.
cash there. Yeah. Don't
Do
go
not.
on. You don't need to.
That's the
Right?
key word.
So,
The extra is the key word. Again, if it's extra, again, we can throw that extra money toward those investments.
It's like getting a loan shark in Vegas. You go
Right.
ahead, yeah, they go give you that money, and you don't return that money.
You might be missing a knee.
Same thing. It's the same pressure. But obviously, it just doesn't get that bad, But
Absolutely.
right. Yeah, you just
so
it's just be safe, man. You're gonna hear it a lot. Just safe, smart, prudent invest. That's what I would do.
So I want to circle all of this back because again, Coach Casey, first of all, this is great information for someone again that has a very, very general knowledge of finance, right? One of the things that I wanted to kind of circle back to again is um, getting that financial advisor. Because again, there takes a lot of information. Obviously, this is a lot of information. You've been studying this for years. This is what you live and breathe. So this is easy for you, and for a lot of us. And again, we talk about this on the pod all the time with a bunch of different professionals, just like yourself. This is what right? And it's sometimes we have to swallow our pride and find a good coach to get us through to the next level. One of the things that I've heard numerous times, and I got a couple of questions from some people that from our fans out there, is that I don't feel very comfortable at times sharing my financial information with a financial advisor because I don't know what they're looking at. I don't want them to know how much money I'm making, or I don't want them to know, how bad it actually really is for me, because I don't want to have that judgment. For the listeners out there that may get in their own way, that may stop themselves from reaching that coach, what would you tell those individuals? I'm sure you've dealt with this numerous times over.
All right. So if you broke a bone and they were like, man, you need to go to the doctor, and you were like, man, but I wanted to see how I broke my bone. I don't want to be embarrassed when I tell them like I fell off the bed or something like that. It
Right.
sounds stupid, right?
Right.
So the financial advisor is there to help. They're not going to be like, damn, like, what are you spending? You got like $10,000 in OnlyFans? Like that. They're not going to do that. Like, they're going to look and say, all right, this may not be pretty. Okay, here's what we need to do. And they're going to sit you down. And like I said, they're going to have you're going to look at your personal statements. They're going to say, okay, how much money you have coming in? How much do you have coming out? What are your goals? What are you, if we have a high amount of debt, let's attack that first, right? What, do I have to pay, to start saving for college? Like what are they're going to do a whole profile on, right? And that all gets stored in the software. So it's easy to see. And here's the thing, you can call them, within reason, like almost any time, and say, hey, I just want, I'm just worried about this. Like, could you talk me through it or whatever? And be like, yeah, sure. Let's talk about this. Here's the plan. They're a coach of your finance. That's all it is. That's why I really enjoy it is, you're helping people. It's like a kid. Like if you were playing football, would you be like, I don't want to ask, it's a lot of people do this. I don't want to ask Coach Quay. I don't want to sound stupid, right? It's
Right.
going to look real stupid when you go out and run the play and you don't know what you're doing, right? It's the same thing here. Like, yeah, you don't want to be embarrassed. I promise, no matter how bad you think your situation is, somebody is worse. Like, somebody is worse. A lot of people you think are rich are highly leveraged, meaning they use a lot of debt. So you may think, oh man, I got student loans and I'm trying, like I'm saving, I'm living below my means. It's not happening as fast as I want. Man, you're probably ahead of a lot of people you think you're behind.
Man.
Okay. So it's like that old picture of the two miners, right? There's one that's been digging for a long time. He's right there next to the diamonds. And the other one is just like way behind. But the one that's right next to it gives up and turns around and walks back. But that other guy's he's going all the way to it, right? So you never really know how close you are. Right? You never really know. So when you think about stuff like that, it's like, yeah, I'm in a crappy financial position right now. If you don't do anything to change that, or at least, make an effort to take positive steps towards it, it's going to stay that way. It's like, it's insanity. It's doing the same thing over and over and over and over. I always say I'm a quarterback trainer, right? I do that on the side. If I have, a girl, right? A daughter, right? We're not pregnant or anything, but if we ever have a daughter, if she wants to play soccer, softball, whatever it is, I'm sending her to that coach. I'm not going to I don't know what I'm talking about, right? That's not my area of expertise. I'm not going to teach her something she doesn't need to know or something that's going to screw her up or put her behind. I'm going to send her to someone who knows what they're talking about. Same thing with a financial advisor. Your buddy who watches investing videos on YouTube, right, may know some buzzwords. Okay. He doesn't get paid to do this, right? Okay, as financial advisors there's no benefit to a financial advisor losing you money, right? It is fee, and sometimes it's based on growth, right? So if you're not making money, number one, you're not going to be happy with us. You're probably going to leave. Two, right? You're not going to be any referrals. Financial advisors, just like any other sales position, you have to have referrals are your number one way of making money, right? New clients, like, hey, I'm really happy with this guy. You guys should give him a call, like that. They want you to make money and be successful. So I know there's a lot of notions, like, again, Wolf of Wall Street. That guy was not a financial advisor. Okay. He's a stockbroker. It's different. Okay. Financial advisors aren't just investing. It's, hey, here's my budget. Should I make this purchase? It's an all-inclusive, right? Hey, can I afford to buy this car? If we move some things around, you could, but it's probably not, not yet, maybe in a couple months. Let's invest here, or let's save here for another 3 or 4 months and we can do it. That's a financial advisor, right? Most of the stuff we do isn't directly investing. It's advising on things. It's moving money around. It's, hey, I need to take out this much money so that I can pay for, my daughter's graduation present, whatever it is, right? So it's a comprehensive thing. So take the chance about, it doesn't have to be a big time, corporate, investment bank, financial advisor. There's ones almost every bank, but these people do this for a living. Like, this is what they know, right? So just go take that chance and you'll be happy for it. It's less stress on you too. So,
Coach, I have a question. Goes back to something that you mentioned earlier. You talked about diversifying your portfolio. And I asked this question because I recently, like within the past month, my wife and I had the conversation about, because she read it in the book about diversifying the portfolio. And I looked at my account. I was like, I am diversified. I'm in this much equities, this much fixed income, this much cash, this much real assets, and things like that. Then I went ahead and dug a little deeper, and I was like, oh crap, I'm in nothing but large caps. I have no exposure to nothing else. So I'm literally all in on just one sector of the market. What does a diverse, I know you can't fully say or put this much percentages in these types of things, but can you expand a little bit upon like what other areas of the market there is, like a large cap, mid cap, small cap, and the different sectors? Can you explain a little bit on that?
so I'll be broad with it. It's so, for example, you can have different types of assets, right? So you could have stocks, bonds, different types of securities, stocks, bonds, real estate, fixed income, annuities. Annuities not really a variable annuities, not really a security, but there's different things you can invest in, pay for, right?
Mhm.
The whole point of diversifying, like we said, don't put all your eggs in one basket, is every single sector is going to dip, like every single one. Like if there's not one that's immune to losing money, it's going to happen, right? What you're doing is you're managing that loss, right? So there's so many things you can invest in. Okay, now definitely research what you're going to invest in, but there's a lot of different ways to diversify your portfolio. There's even an exchange traded fund, an ETF. So what that means is it's a fund, right? So it's a professionally managed, collection of assets. It basically just tracks a index, right? So the S&P 500, whatever that stock index is. They actually have reverse ETFs, right? So inverse ETF is basically if that index goes up, I go down, right? So that'd be like, okay, I'm betting on this index to, go down more than it goes up or whatever, right? So if it tracks the Dow Jones, if that goes down and takes a huge crap on the day, the reverse index goes up. They have all sorts of different securities and investments. Do the research on things you're comfortable with, right? Don't invest in it just for the sake of diversifying your portfolio, right? If you don't know what you're buying, you shouldn't be buying, right? So maybe you see something like, oh, that's interesting. Like I bet Luna saw some stuff. Like, oh, I'm gonna go do some more research on that before I put it in my portfolio, right? Because if I don't know really how it works, and I blink and I look in a week and I've lost money, I'm like, how did this lose money?
Right.
Right? Okay, so do your research like you would on anything. But yeah, you need to diversify. You should never have all your eggs in one basket. I'm trying to answer this as much as I can. But a lot of times you can look up, like you can basic Google search will tell you a lot. Like just Investopedia. I don't know if you guys know what that website is. I lived on
Got an
that in
app too.
college. And any kind of security, any kind of investing term you want to know, type it in. It comes up with a full explanation, right? And I know this sounds boring. Throw on an investing channel for the day, right? So they have them on TV all the time, okay, and whatever streaming service you have. Throw it on during trading hours, okay, and watch. They'll talk about stuff that's going on in the market. They'll talk about. I wouldn't take their investment advice at face value,
Especially
because
Jim Cramer.
a lot of times they're either out of touch or they got someone in their ear telling them what to say. But look at the trends, right? At the bottom, you'll have the ticker, right? Learn how to read that. Okay, the stuff like that. If you're truly passionate about investing, that's all stuff you need to learn, right? Because you do research on stuff you want to learn in the rest of your life, right? If I'm, starting a linebacker training business, I'm going to research, hey, what are some new developments in the world of playing linebacker? What are some drills? That's what I did with quarterback stuff. I thought I knew a lot. Man, there's a lot of stuff that I didn't. Just like investing, you can never know too much, ever. Do some research, put the grunt work in. It makes a difference, right? So that's my biggest thing is definitely diversify, but know what you're diversifying with.
Coach Casey, I got another one for you. Another one of our fans reached out and gave us another good question. Is it fair to say, when it comes to investing, I should look more for investments that I'm currently shopping at, i.e., Sony, um, McDonald's, Nike, so on and so forth.
That's an interesting question. It takes some context because it's like, where are you shopping, right? Like McDonald's, sure, right? Huge company. Okay. Um, Sometimes people shop at very niche things that don't have a large market share, meaning like,
Mm,
yeah, you may really like this store, but does the store really make that much money? Like, so um, yeah, I mean, there's something to it because usually people are investing or they're shopping at bigger corporations, right? So like Amazon's a good one. Everybody uses Amazon.
hmm
Um, it's a relatively safe investment. They just had a stock split a couple years back, so it dropped the price a little bit on a good way. But as far as that, I think everything takes context. You know, if it's a reputable, like successful company over time, sure, right? That's something. Anytime there's a successful company that's shown history of being consistent and dividend paying, and they're very transparent with their annual report, right? Their financial statements, they put it all out there on time. It's easy to read. You can kind of look at it with yourself, right? And they're never in trouble. They're not facing a ton of sanctions, things like that. If they're reputable, sure. I don't think that, having a portfolio entirely around your favorite things is always the best plan.
hmm
But having a couple stocks in there that you are familiar with, it kind of makes you feel, I guess, better about investing. I mean, as long as they're ones that you're comfortable with, it's like having a fantasy football team and throwing a player from your favorite team on it.
Right.
You're not going to stack your team full of your favorite team's players unless you're like the Niners, right? Um, but you can throw one or two in there. It's like, oh yeah, I like having this, right? I like having the Target, or whatever my favorite store is. So
Right.
yeah, there's nothing wrong with that.
All right. And then another good one. As far as it goes with 401ks, I currently have a 401k right now where my company is currently matching me um, at 4%. Is there more that I can do to expand my options for my basic 401k, my basic 401k investment opportunities? If this is something that you
So
can answer.
I'll try to. I'm trying to figure out exactly what they're asking. I mean, Coach Luna said, I'll try to say this. So I would never have one retirement account. Um, so you have you have a lot of options, but two basic, you can open up a Roth IRA or traditional IRA. Okay.
Mhm.
So one is qualified. I'll explain it this way. A qualified retirement plan. Okay. That means that they're going to take money before they tax it and put it in your retirement account. And then when you withdraw it at retirement, they'll tax it. Okay, that's qualified. That's usually a traditional IRA, right? A Roth, right? You're going to pay tax on it before you put it in, so it's post-tax money.
Mhm.
Okay, but then when you take that money out at retirement, assuming you're over retirement age, right?
Mhm.
You're now it's tax free, right? So you're making the decision. Okay, if I put the money in now before taxes, is inflation going to outpace it so much that by the time I take it out and it's taxed again, it's going to be worth significantly less?
Right.
Or do I say I'm going to tax it now, assuming that inflation and taxes are only going to go up in the next 40 years? So that's totally up to you. I'm not going to say what you can or shouldn't do. It's kind of just do your research on it. But I personally, I have the 401k, I have a Roth, I have, just, other investment accounts. It's a perk of working in an investment bank. But like, for example, our 401k, if you buy 3 shares of a stock, they'll buy a share. So things like that. Different companies do different things. But I, in terms of, it's like diversifying, right? Don't just have one retirement account. Try to have multiple, right? So that'd be a good thing to talk to a financial advisor about, right? So you bring them in. Hey, what do you recommend I do as far as, my specific situation? And that's what they're there for. Like general advice isn't going to do much for you because you'd have to see your financials and kind of what your goals are and all that stuff. But that's a great intro for a financial advisor. Hey, here's something I'm working with. Is it what do you recommend? And they'd be happy to explain all that for you.
That's awesome. Coach Casey, I cannot thank you enough, sir, for the information. This has been gold. This has been gold right now. I know that we're gonna have a ton more questions that are gonna be plowing in after this. Coach Luna, Coach Wash, you guys got any closing remarks before we start wrapping up?
Question. So I want to get into commodities, right? And I'm not just saying for me, I'm just a person, I'm just speaking in general.
Mm-hmm.
When I buy like a share of like an ETF of gold or silver, that doesn't count as an actual like representation of I own this much gold or I own this much silver, correct?
No, it's tracking that market. So essentially, like it's if the value of gold goes up, your investment's going to go up, but you don't own that gold. Does that make sense?
Yeah,
So it's kind of
100%.
like, on Robinhood, when Robinhood started first getting into crypto, I don't know if y'all remember this. I know Luna and I would talk about this in the office. I think it was, and I don't quote me on this, but I believe when Robinhood first started offering crypto, you didn't own the crypto when you bought it. I believe it was like a mirror of the value. So like we had a coach in our office that invested in a lot in Dogecoin, but I was almost positive. I was looking at the deal. I was like, I don't think you actually own any. I think you own the equivalent amount that's tracking it. So I may be wrong on that. I remember reading about it, but it's kind of like that where you don't own that commodity, right? But you're going to make profit if that commodity is doing well. And if that commodity is not doing well, you're not going to make money. So
It's
that's
just,
kind of like,
tracking that movement.
right. It's like an ETF, right? An exchange
Mhm.
traded fund, or it's like a mutual fund. Sometimes a mutual fund is just like a collection of investments that's managed by usually, one or two people, depending on what the mutual fund is. But it's professionally managed, meaning they'll go in, they'll sell a stock if they think they should get out of it and buy another stock, or they buy more stock, at whatever, right? And you buy into it, meaning you're not having to make investment decisions, and they're doing it for you, but you can make money or lose money from it. So it's kind of like that. You don't own the stocks in a mutual fund, you own the mutual fund, or you're part
Makes
of the
sense.
mutual.
So, but I can go on financial and all this all day. Is there such thing as like too late? Like I may have missed the boat
To start
on
investing,
investing. Yeah,
I
like
don't
is there
think
such thing as that?
I don't think it's definitely not an age thing whatsoever. It's a means thing. You could be 25 with a bunch of money left over to invest, or you could be 55 with no money, right? I think number one, if you do the right thing like we talked about earlier, and you take care of your liabilities, you take care of your debts early, you're going to have more money down the line, right? Ideally. I can't speak for everybody. It's not like, oh, if you pay off your debts, you're going to make money like that. There's no absolutes. There's no guarantees in finance. Stuff happens out of our control all the time. But there's very few scenarios where paying off debt and liability is bad, right? That doesn't, like, at the very worst, you have no debt, like whatever it is. But I think every situation is different. I 100% don't think it's an age thing. But I think number one, I would say as you get older, especially if you have kids, start working on setting up your estate. So a lot of people have trusts, estates, whatever. Okay. So basically your will, everybody writes a will, right? Your will determines where all this money goes. You start setting up an estate, you have a trust, an estate, whatever. Your trust, okay, you have a trustee. So let's say something happens and God forbid you die in your 50s, your daughter or son is 15, right? Whatever. They're not old enough to do any of that. You have a trustee. So usually it's your spouse, right? So the spouse would then be the trustee and they'd be in charge of that estate or whatever it is. And then let's say tragically, what if they both pass, right?
Mhm.
And then both parents are gone, but that kid is not ready yet to inherit that stuff. Well, then there's a trustee that maybe is outside of the family, maybe an aunt and uncle that can take care of it and make sure that the kid doesn't get taken advantage of, or whoever the
Right.
beneficiary is, kid, whoever it is. But start thinking about that. Like, I know you don't want to think about your death. Nobody wants to think about leaving your family, but you're going to hurt them so much worse if you leave them unprepared. Right. So if you don't leave, and it has nothing to do with leaving a legacy or anything like that. If you don't leave with a plan, if you don't have a plan for, hey, if God takes me tomorrow, what happens to everything? How are my family? How's my wife? How are my kids going to get taken care of? That's when you're going to really regret that later in life. You're like, man, I should have done this earlier.
Mm-hmm.
Right. You got to have that set and tell your kids about it. Hey, here's how this is going to be handled. My dad was great. My dad was very transparent with me growing up. And I really respected that because he kept me in the loop. So when I was old enough, he said, hey, everything we own is in an estate, right? It's in a trust. I should stop saying estate. Estate is what you own, right? It's everything in your name. It's in
Mm-hmm.
a trust. So, no one can lay any claim to anything we own, right? No one, like, for example, if let's say you and your wife, your parents don't like your wife for whatever reason, right? And they're like, I am not, as soon as he inherits this money, she's going to leave, right? I kind of just know it, right? A lot of people like that. They put it in a trust, right? That trust is in your name. That's not splitting when
Mm-hmm.
she tries to leave, right? So it's not something where they're just passing you down assets. They're passing you down ours is in our house. It's a binder, right? You go to a lawyer, you get it, you draft it out. It's a whole thing, but you'll be so happy you did it, right? So I'm not going to say estate because estate's just what you own, what you have in it. But start a trust, okay, for your kids, for your wife, whatever it is, so that you have a plan for what happens when that day comes.
Now, I kind of want to ask the question on this one too, because you hear you've heard historically, make sure you have a will. Now, can you explain for us out there, especially for myself, that difference between that trust and a will?
So, so a trust is more. I'm trying to think. I'm trying to put it in layman's terms because, like, a trust. I'm gonna try to see if I can even. Yeah. Okay. So a will only kind of kicks into effect once you die. Okay. A trust is planned for when you're alive. Okay. So there's a situation where, um, so when a will gets put into effect, there's something called probate, and then trusts don't. Okay. So I don't want to get too in depth with this, but
Mm-hmm.
like, a trust is going to cost you a little bit more, but to create, but it's one of those things where a trust is going to make it to where it's much more clear your intention, right? And it's hard. I'm trying to find ways to say it without saying too much.
Right.
Um, but you're essentially, it's a much easier succession plan, right? So a living trust happens when you're alive. A will happens when you die, right? Trusts are harder to change. Wills are easy to change, right? When a living trust, as soon as you die, assets transfer. A will does not automatically transfer, right? It takes some time.
Mm-hmm.
Living trusts are always private. Once you die, it stays private, right? Where your money goes. A will becomes public as soon as you die. It's public information. What the other side, like a will is easy. Everybody has a will. It's affordable. A living trust is more expensive because you're paying for the extra,
Right.
expertise and the extra security. Um,
that
not,
death insurance, essentially.
right. And it's not like a thing where, you're screwed if you don't have a trust. A lot of people don't have trust. But it's essentially like we talked about earlier. It's more time and cost now. But it includes some protection for your family. Whereas with a will, it's not as costly now, it's costly later, but you can't really protect your family. Does that make sense? So
Absolutely.
it's you're paying that premium for the security and the protection of what's passed down to your beneficiary.
This has been great information. I don't know how many, I was going to say, Luna, I don't know how
I
many
got a
pages of notes
whole
you got.
page. I got a whole page, man.
I'm on page 2 right now. So this is great, man. This is great. Again, Coach Casey, I appreciate you being able to, drop the knowledge that you've been able to drop on us. Obviously, I know that there's much more that you can be able to provide for those individuals out there that would like some more information. You got to get yourself a financial advisor, which means you got to get yourself a coach.
It's worth it. Yep. It's worth it, man.
Whole point of the podcast, right? Coach Life podcast. When we talk about the life portion, we're talking about your life coach that you may need. Again, I want to keep prefacing that because I keep getting hit up on that. But again, Coach Casey, I thank you so much for giving us this feedback, giving us this information. Again, this is very crucial information that's going to help change a lot of people's lives. And you definitely hit the nail on the head when you said, again, you go break a bone, you go to a specialist, right? You go to the doctor. Not going to find a financial advisor for something as critical as your money kind of doesn't make too much sense, right?
Yeah, yeah, and it's I mean, bottom line, man, it's every person's different, right? Every situation's different, but in the end, I think everybody's goal is, and like I always say that money doesn't buy you happiness, it buys you freedom, it buys you security, right? I don't got to worry about, providing for my kids. I don't got to worry about, paying my mortgage. I don't got to worry about that. And that lack of stress or that relief of stress is going to make your marriage better. It's going to make your job feel better. It's going to make you sleep better. Right. So money isn't going to directly give you happiness. Like receiving that check isn't going to directly be like, oh, I'm a happy person now. But the side effects of being financially free or financially, more responsible are going to result in less stress and more happiness. So don't be tied to, oh, I make this much money, I'm so much happier now. But if you're smart there's a lot of people who make millions of dollars very unhappy because they don't know how to manage it. You're not financially free just because you make 6 figures. Financial freedom and financial security is because there's a lot of people making $70,000 are financially secure because they're smart with their money, or maybe they have an advantage other people don't have, whatever it is. Just like you're never too late, right? If you're never making so much money that you're not, worried about your finances anymore, right? Because people tend to, the more money I make, the more expensive my taste becomes, and it levels out. When in reality, like I said at the beginning, if I have, average taste, right? If I'm not super rich taste when I'm not making money, why does that change when I start making money?
Right.
Right? Why does it change? Because that space in between my hands is the extra money, right? I may not have much here, but now I have a bunch. But if I do this, I'm right back to where I was. Doesn't matter. I'm working harder, probably working more hours, stressed out at work, and I haven't received any benefits because now I'm spending more money. Right. And most of it is just childish stuff.
Warren Buffett still lives in the same house that he lived in since
McDonald's
like the 90s.
every day for breakfast.
Goes to McDonald's every day. He's been driving the same Cadillac for like 20 years. And we're talking about one of the individuals that have walked the earth as far as from what we know, as far as from our lifetime. Like that's just a crazy concept. You just sit down and be like, man, people over here stressing about Ferraris, Porsches, all this other stuff. The richest individuals on earth are chilling, making a Ferrari amount of money every minute of the day by dividends and investments. Man, come on, man.
Well, when you see you like teaching when we were teaching and coaching, you see kids walking around with like $200 Yeezy slides on,
Mm-hmm.
and then you're like, you ask them like a football player, like for example, they have to pay for summer training, right? Which is so cheap. It was so cheap. Our summer conditioning camp, which is how we got paid in the summers, was
Mm-hmm.
so cheap. Half the kids were going for free because we were just like trying. We just need you here. They're out in like $200 shoes. I'm like,
Yep.
so you can get $200 shoes, but you can't pay $50 for a summer camp? Like it has it, and there's a. I'll finish with this. So this is I actually read this in I just finished this book, Psychology of Money. So it talks
Mm-hmm.
about how
That's
just
your other reference right
because
there.
just because you know something about a subject doesn't mean that you're always going to practice it. So, for example, doctors probably know I'm not supposed to drink a lot of alcohol. It's probably not good for my body. A lot of them still drink a lot of alcohol, right? Okay. Financial advisors, people who go get, MBAs and pass all these security exams, know they're not supposed to spend a ton of money that they can't afford. A lot of them do, right? They'll tell you what to do till they're blue in the face. But when it comes to their own life, they don't do that. So the big thing is, you can learn all this stuff and you can teach yourself how to invest and manage your money, and that's great. But unless you live by it, it's not going to make a difference. It won't. Because the minute you start making more money, you see that bank account go up, and you're like, oh, it's working, it's working. And then you fall right back into where you were, you know? And then it's like all that work you did, it's like doing a diet for 2 months. And I lost 20 pounds. And then he's like, oh, I guess I can have an extra snack here and there. And then you blink, you're like, oh, I'm back to where I was, right? This is not a get rich quick, scheme. If you're serious about, changing your finances, this is a lifetime thing, right? It may be kind of inconvenient at first because you gotta like, oh, I gotta balance. It's not fun to look at your balance statement and your income statement or balance sheet and your income statement because sometimes you're like, man, this is embarrassing. That's what a lot of people need.
Right.
I don't think a lot of people realize how much money goes out every month. They just see the end of the month and they say, oh,
What
that's a
happened?
lot of money. Yeah, where'd all my money go? It's like, oh, I went to Starbucks 4 times this week. And then I went out to eat Thursday, Friday, Saturday, Sunday. And you can't go out to eat and have a drink without paying $100 for two people anymore.
Easy.
So, I mean, it's like sometimes you got to sacrifice, man. And the last thing I'll say before I head out, I meant to say this, credit cards. Okay. Credit cards. This is what I told my senior economics class 2 years ago. Get a credit card. Okay. When you get that credit card, use it like a debit card. Okay. So when you look at your credit cards, a lot of times you get like I have a Chase Sapphire Preferred. So it's through Chase, which is my bank. It shows my checking, my savings, and then my credit card. So checking and savings, when you spend, go down, right? Or you withdraw, whatever. A credit card, when you spend, go up. So what I need to do is when I look at my credit card statement, I need to look at my checking account, right? So I need to say, okay, I'm not going to spend $3,000 on my credit card this month if my checking account's at 2,500.
Mm-hmm.
That's how you go into credit card debt, or you're having to take out of your savings. So if I look at my car, or if I look at my checking account, and I hope you don't have this, but I look at my checking account and it's at, let's say $3,000, and my credit card statement is at 2,900, and I'm about to go out to eat, I should probably rethink that, right? I find something at home.
But Coach
And
Casey, I want to go out. I I, I want to go out. It's Friday. I had a stressful week.
everybody has stressful weeks, man. Everybody has stressful weeks. That's the thing is like it's the treating yourself. That's a big thing. It's like, man, I worked my butt off this week. I deserve to go out and have some drinks with my buddies, go watch the game. Sure, if you can afford it.
I'm
Because
asleep.
that short term gratification is not worth the continual stress and worse situation you're gonna put yourself in.
It is.
Because all your friends that can go out to eat and do all that stuff, or even if they can't and they do it anyway, they're going to be like, why don't you come out anymore, bro? Why don't you come out anymore? Why are you just avoiding us? No, bro, I got to get my life in check. Like, I got to get my stuff together so that in 10 years, I'm not living paycheck to paycheck. You know, that's the real, like, don't be embarrassed to say that. It's a lot. I guarantee you, everybody you're going out with, most of them, they'll never tell you when they're financially struggling. They could be in the hole. They're never going to tell you. So don't assume like they're going to judge you for you maybe like staying back home. Maybe I'm not going out this weekend. Maybe I'm going to chill at home. You know, maybe I start crafting a business, right? Find something. Luna's been on his phone all day at school. He's planning his linebacker training, right? So, I mean, I'm sorry, off the clock.
I'm working.
He's working.
That's exactly right.
Intensely working.
But that's what it's going to take is, hey, maybe I sacrifice that short-term, you know, pleasure for some long-term security, right? And I know everybody's done it. I swipe my card, and I'm like, man, I shouldn't have done that. As soon as I swipe it, buyer's remorse. I'm like, this food's going to be gone in about 10 minutes, and I could have used that money for something that's going to last me a lot longer.
Yeah, you know? Coach Casey,
so.
I have a 60-inch TV. When I was in college, I swiped for a 60-inch TV because why not, right? I walked into Best Buy, I got my apartment, and I was like, you know what? This big ass wall needs a big ass TV, and I'm putting up a big ass TV. And I bought that and the stand that came with it, and that really hurt. That really hurt.
It needed a surround sound. It needed the sound bar.
It needed this. Everything.
It needed that. It needed the action lights on the back.
Going nuts right now. Run it up.
And that was a decision you made, and you knew what was going to get charged. You knew exactly what was going to be, and you still regret it. Man, let me tell you a quick story. When I knew I was going to propose to my fiance, I think I told Luna this. I knew I was going to propose to my fiance. I went to Robbins Brothers in the Galleria area, and I picked out the perfect ring, everything, right? It was, you know, good size ring, you know, wasn't cheap, wasn't like crazy expensive, but wasn't cheap. And they set you up, like when you get your engagement ring, they set you up with the credit union you're going to pay for the however many years that you're going to pay it off or whatever. Like you're going to make this many payments of this much money, blah, blah, blah. So I'm like, cool. I get the ring. I thought I set up the credit union card to like, because you have to go in and physically say, okay, every month I want to take this much out.
Right.
Right. I thought it was already like that, I guess. Like it was already pre-approved. So I blinked one day, like a month after I bought it, and it took the entire balance of debt that I had left on that ring out in one transaction. So imagine if I didn't have a good savings account. Imagine if I didn't have a good savings account and like an emergency fund. Now, the good news is that's a liability that's gone. That's a debt that's gone.
Right.
But if I was sitting there with barely, because like in your mind, you buy it, it's not really, you know, this much money. It's small payments of this much money for this many years, right? It's like when you buy a house. No one has $400,000 to buy a house, right? It's just you're paying a little bit at a time. Like people do, but not me. But the ring, I was like, all right, it's only like a couple $100, you know, whatever, or every month for a couple of years. And then I got taken out at once. And I was like, man, if I did not have ample reserves, I would be in such deep shit right now. And that's why I talk about an emergency fund. That's why I talk about saving. Because that I was perfectly fine with that amount of money taken out over 5 years. I was not okay with it getting paid at once. It was like it felt like a down payment on a car. Like I was like, oh, like, I'm not talking a used car. Like I'm talking like
a brand new car.
Like I'm 24 years old. Concept car. I cannot afford that right now. And it hurts me still because like I love opening up my savings account and seeing like a large amount of money. It makes me feel good. But when it took that much out, I was like, oh, I hate myself. You know, so you know, that's a real life experience. I have a background in finance. It's what I do. That happens to me too. Happens to everybody, you know, but because I was prepared, because I had great people telling me what I should be doing my whole life with finances, I was prepared for it. So, and I mean, my biggest thing, if you take nothing else from this, just sacrifice, man. Sacrifice in the short term. I live in it sounds funny. I'll tell you, the playing field's never level. Like Luna knows, my parents live in Hawaii. I live in the house with my fiance I grew up in. Okay. I only pay utilities. Okay. Not everybody has that opportunity. Now, that doesn't mean it's like, oh, this is everything I want. Who wants to be in the house they grew up in when they're 26 years old with their fiance? Not a single person. If you say yes, you're lying. Right? It's tough on her. It's tough on me because it's like I feel like I'm stuck. But I also know that I'm not paying a mortgage right now. I'm not paying all this extra stuff. I'm still driving the same car I drove since 2015, right? Because I want to have that extra money. You know, I want to have that savings. When we have kids, I want to be like, hey, we got plenty of money to raise a kid. I don't want to be like, shit, we got to cut back on all this stuff. Like, I want to be prepared, you know? So, you know, sacrifices aren't all the same, just like, you know, situations, finances aren't all the same. Everybody's different. Just do what you can tolerate. Don't make yourself miserable. Do what you can tolerate a little bit at a time and just chip away until you get to that goal that you want. So that's my spiel.
I love it. I love it. Again, it's like a circle.
Always comes back.
Everything that we talk about, again, all comes back to a basic fundamental strategy: being organized, being honest with yourself, being able to hit that reset button, swallowing that pride, and finding yourself a good coach.
And still learning.
Man.
Even as a coach, you still gotta learn.
That's the one thing that, again, we've heard throughout every guest that we've had on since day one, that each one of these coaches, and even us as coaches on this pod, we're consistently learning. We say this all the time. We're not the industry experts in these areas, so we find the industry experts like Coach Casey to talk to us a little bit more about how we can get better and get sharper, right? Iron sharpens iron. So we were consistently trying to find those individuals to help us be better and know better so we can start making better moves. So again, Coach Casey, I cannot say this enough, sir. Thank you again so much for blessing the podcast, brother.
Man, I appreciate you having me on. Appreciate it. I'm like Luna said, I'm still learning. I'm still figuring stuff out too, not only in my career, but in my life too. So you guys don't be discouraged no matter where you're at. Just, hey, tomorrow is a brand new day. Sit down, start with step one, make those reports. Where's my money coming from? Where's it going? And just do it one step at a time, man. Don't try to do it all in one day. Take your time, you know, enjoy it.
How do you eat it? It's the same thing you hear all the time. Like, how do you eat an elephant, right? One bite at a time.
Yeah.
That's it.
I ain't even know it.
You didn't know that one?
That's the first. He's gonna use it like 8 times tomorrow.
I was gonna say that's written down in the notebook now.
It's like when a kid learns his first cuss word.
There it is.
Just says it in a bunch. That's Luna tomorrow.
Find a reason.
Gotta eat the elephant.
Exactly. Like, what does that got to do with what were we just talking about? Again, for all everybody out there, again, if you like what you heard, please hit that like and subscribe button. If you want to hear more from your Coach Life podcast family, again, as always, stay positive, my friends.